Hello, everybody. My name is Bruce Weinstein, and you are listening to Ask the Planman. Everything you wanted to know about finance, insurance, investments, and more, but we're afraid to ask. Today, we are joined by Craig Port. He has 25 years of experience across several financial-related positions. Most recently, is the area manager for Power Financial Credit Union. He's responsible for both member and asset growth throughout the community branches. He holds an MBA in Financial Services Management and most recently obtained his Certified Treasury Professional CTP designation. And Craig is here today to help make credit reporting and understanding your credit scoring fun. Welcome, Craig, to Ask the Planman.
Hey, thanks so much for having me on, Bruce. Just wanted to throw out there for everybody listening on the credit unions. Credit unions are open here for anyone living or working in South Florida or even going to school in South Florida. We have 35,000 members at Power Financial Credit Union. We're full service and a modern institution.
Give us a sense there. What exactly is the difference between a credit union and a traditional bank? What would you say?
Great question. So I think the first thing I would say is credit unions are a co-op. We work together. So imagine yourself, you're traveling the country and you're with a major bank and you're looking around for that bank in the area where you are and you can't find it. You cannot just walk into another bank and make a deposit or withdrawal. But credit unions all work together. We don't compete. Makes it easy. So 5,000 locations throughout the country. So no matter what credit union you're a member of, you can do business with another credit union. So it makes things easier and more convenient for our members.
Okay. And the bigger banks might be termed money center banks, right? The Citigroups and Chase and some of the big names that have more of a national footprint. And from a sense of lending, and we're going to get into credit scoring, credit histories, for the crowd, but if you correct me if I'm wrong, the credit union, for lack of a better term, will eat what they shoot. They're keeping the business, they're not reselling or packaging the business, and so they want to stay and be involved in their local communities, promote lending, but they're keeping those loans on their books. They're not farming it out and just packaging it to Wall Street. Is that a fair?
Yeah, I think you understand credit unions very well, better than most. So, right, by being in the community, we have a responsibility to give back to the community since we're involved. And that's one of the ways we do it. We work with our members. We take our members' money in. It's a simple process where we'll take the members' money in and we'll lend it right back out to them, at the lowest rates possible. So we're in it to help the lives of our members. So that's kind of it's simple, but it's not so simple.
Of course.
That.
Now, I've heard you reference that the credit union is a nonprofit. I don't necessarily understand what that might mean. I'm sure the audience might not understand that interpretation, whereas Bank of America is a publicly traded stock. They have dividends and they are looking for earnings and profits. That profit comes from the people doing business with the bank, right? So that increases the value of the stock and the company. So they are for profit, if you will. So how does a credit union, in essence, become or labeled as a non-profit? And as you're saying, it's part of it's going to be in how they package and price their lending. The
nonprofit certainly helps us out in that the way we're organized through accounting so we can help our community out. But the main thing is, so we have a board of directors. They're all volunteers. So we're not paying high-powered people to be on our board. We have people that are members of ours that are on the board, and they volunteer. So there's no money there. So there's a great cost that we can pass through to our members. We also are the first bank.
Cost savings.
Yes.
Right.
Yeah. Cost savings. And the first credit union and bank, for that matter, in South Florida, we've done away with our overdraft fees. So there's a good chunk of our income that we're giving back to our members. We don't charge $35. And because of that, we're able to, and we don't pay high rates for CDs. So basically, we're able to take the money in from like a co-op from our members, and then we'll lend it back out to our members at the lowest rates possible. That's why, my first knowledge of a credit union was getting an auto loan, because everybody said you had to go to a credit union because the rates are so low, and it's true.
Okay, great. I just wanted to share that with everybody so they kind of understood the fundamental differences here. So let me set the stage why we invited you on the show so the audience knows, and we've got some tremendous so what's for everybody here, is I'm in the financial services space for over 35 years. And I heard Craig speak a few weeks ago about how credit reporting is done, how you can improve or what's the word I want? Degenerate your credit scoring, and all these different components of what goes into people's credit scores and how banks look at things and how it's not always so cut and dry. And I was overly impressed, and I actually said, I'm doing this a long time. I didn't know half of what you talked about. So as we're launching the show, Ask the Planman, I felt this is something finance related that everybody out there needs to know and understand how their credit is impacted, calculated, derived. So I want to kind of give you that form. As we said, we're gonna interact on it. I may stop and ask you some questions along the way, but let's break down for everybody the ABCs of credit, the reporting companies, who might be the more heavy-weighted ones, if any, how people can improve their scores, and obviously where they're going to damage their scores. So go ahead, let's just kind of break it down.
Yeah, credit, it used to be a mystery to me, and I know it's a mystery to most people. The key thing you want to know is the whole credit scoring purpose is to tell us the probability of default in the next 24 months, and that's what lenders are looking at. And a default is, missing a payment after 30 days. So, just keep that in mind. But you're right. So how can something so impacting in life be a mystery to all of us?
Most people have no idea.
Right. But the credit score doesn't even take into account somebody's employment history, their income, their housing situation, which is also is important. So I understand that's, a lot of the things that people, hey, why is my credit score so low, or how can I get it going?
So we've got, again, from a lending standpoint, you've got mortgages, right? People looking to borrow money for homes. Probably the biggest expense and amount of money they're ever going to borrow would be a mortgage. Credit cards or revolving lines of credit of some kind, which is unsecured, right? And then auto, boats, RVs, whatever. And those are secured because you are buying the vehicle. It might be a depreciating asset, but they are buying the vehicle and there's an asset behind it. So each of these are evaluated from a credit history standpoint. You're taking on a 3-year car payment, a 5-year car payment, a 30-year mortgage, a home equity line of credit, whatever it is. So you're assessing the credit worthiness and ability for them to make and continue to make those payments, right?
Right. So probably the most helpful where we can start is there's actually 5 factors in the credit scoring system. But I would focus for the beginner and wanting to just understand how everything works and get things going is there's 2 factors that are really important. Payment history, which makes up 35% of the score. And then you also have what's called capacity, which makes up 30%. And capacity is just basically the amount of money that you have available to borrow to how much you're actually using. So for example, if you have a credit limit of $10,000 and you use $5,000 of that, you're at 50%. And what lenders look for is for you to be 30% or below, and you're going to have a good score. You can go up to about 50 without a major impact, but the minute you get over 50, you're going to start seeing big increases in lowering of your score.
All right, so let me just, I'm taking notes so we can recap it a little bit later if we need to. So you said 35% of the scoring comes from the capacity calculation.
The payment history, which is like public records, your bankruptcies, foreclosures, repossessions, late payments, any payments missed on your account, or collections, bills, credit cards, overdrafts, things like that.
Okay. What's next?
So, and just I'll add, it's important to mention that some of the scoring models that are out there, because every type of loan has a different scoring model. So mortgages use a different one than auto loans. So some of the models are weighted more towards one type of loan, such as an installment loan. So, that's why there's different scores out there. People, it's great if they're using services like Credit Karma. The best way to use those services are just as a way to gauge, how you're doing. If your score's staying the same, is my score going up? Is the score going down? If the score's going down, then you have to try to figure out why is it going down. But it's not, you don't get that score, go down to the lender down the street, and they tell you their score is different, and then you start arguing back and forth going, well, this says this, and why is my score so low? And you must not know, what's going on. So it's a great indicator to use, but it's not the score lenders use all the time.
Okay. So there's 3 providers for credit scoring, right? You have Experian, and what's it, TransUnion, and who's the third?
So you got Equifax.
Equifax. So is any of them like the leader? Like when we look at car loans, right, or car value, Kelley Blue Book becomes like the forefront where people are getting their pricing for cars. Is Experian the lead? Like, is anybody like more of the lead dog and the preferred usage, even though there's 3 of them, or is they all pretty much unilaterally the same?
So the reason there's 3 of them is they're spread out throughout the country. So depending on where you live, is the credit bureau that is going to be predominant. And that's the credit report that gets reported the most information. So the more information that gets reported to one of those bureaus is most likely going to have the lowest score. So in our area, South Florida, Equifax is the primary credit bureau. And so you're going to have more history reported to Equifax. So you're probably going to have a lower Equifax score on that. If you lived out in California, say, then Experian is going to be your number 1 lender, and you'll probably have a lower score there. The middle of the country is TransUnion. And so for us, you'll probably see if you use those services, your TransUnion score is always going to be the highest score on there. And that's the main difference. The more information that's reported, the more chances are, it's going to impact your score.
Okay. No, thank you for clarifying on that. So what are some of the pieces that will drive down or potentially over time help increase people's scoring? That was a lot of stuff you shared when I heard you speak that, was part of that. I had no idea that's how it works.
Oh, so. I know. Yeah, and I've learned this through experience, through working with my members, my customers on buying homes. I've seen it, tested it out. So I know it's accurate. So the biggest thing that affects the score, I would say, is your capacity. And that's going back to how much you're approved for, how much debt that you've been approved, and how much you're using, and trying to stay at that 30% level. So the quickest way to help improve your score is to get that number down. Now, some things that I shared that are interesting. So let's say you have 2 credit cards and they each have a $10,000 credit limit, right? It would be better if you had $5,000 on one and $5,000 on the other one. You still have that $20,000 limit for capacity, and you still are using $10,000, so you're still at 50%. But if you had $10,000 on one card and 0 on the other, still the same numbers. That card that you had maxed out, $10,000 outstanding against a $10,000 balance, that would give you a very low score. You'd be at 100% capacity, and you're going to lose a lot of points. So it's not good to just use the one card. Some other things that we shared too that you want to be aware of. A lot of people I see tell me that, I pay off my credit cards every month, which is great. But It's what gets reported to the credit bureau that's going to affect your score. So let's just say I have that same $10,000 credit card, and I use $8,000 every month for my points because I'm going to get a lot of points. I'm going to be traveling. I like doing that. And then I wait till I get my statement, and then I pay my $8,000 and I pay it off. Well, how it appears to a lender is the credit bureau is going to report that $8,000 balance against your $10,000 line. You're at 80% capacity. You're not going to have a very high score.
Even if you paid it off.
Yeah, because you have to pay it off before the statement. You want what's being reported to the credit bureau to reflect that lower amount. So even though you're paying off your statement on time, you're still being impacted by a higher capacity.
All right, so let's make sure I'm understanding. So if let's just say there's a 4-week cycle and I'm running up $2,000 a week, traveling, business, putting my expenses on, it would be in my best interest every Friday to pay the $2,000 back and not let it get all the way to $8,000, close the statement for the month, send me an $8,000 bill. That's a derogatory on my credit versus I got $2,000 in, for 3 of the 4 weeks, I paid it down. And then the last week, let's just say I get the statement for $2,000. That's a lot. It's only 20% of the capacity. That would be better.
So if you're able to use your credit cards, for the points and the safety, credit cards carry a lot of safety with it that like debit cards don't. So the person that is able to spend on the credit card and then, transfer that money to the card and pay it down along the way is going to have a higher score than the person that waits till they get their statement, even though, you're doing the same thing. You're paying it off every month.
And unbeknownst, because a lot of business people who travel or are doing it for the points don't realize, I never realized, I used to do that, try not to pay interest. You pay the bill every month, but I'm running it up, getting my American Airlines points and my President's Club and, all that. And then all of a sudden, I'm running up, and I'm not that I'm hitting the wall, but I'm close to the wall, and I write a check for $8,000, and now all of a sudden, it's a detriment to my credit. So that's a good tip for everybody.
Yeah, your aspect, you're doing everything correctly. You're spending and you're paying it off. But when the lenders look at it, they see a different story. They see you're maxed out, and there's no proof that it's showing because it's going to affect your score. So just keep that in mind as a tip.
Yeah. So one of the other things you talked on, I'm just going to go as I remember them because I'll tend to forget some of my questions, and you can jump on them, is we talked about the impact of opening up multiple credit cards. Here's the hook. Here's the catch for people, right? You go to Macy's, you go to Abercrombie and Fitch, you go to Kohl's. Everybody wants you to open up a house account, right? And they'll give you 10% off that first purchase. So you're like, hey, that's pretty juicy, right? Or even 20%. So you're dropping $500 and they're going to take $50 or $100 off. Yeah, fill out the credit card. Give me another one, right? And so we've got a slew of these things sitting in the drawer, maybe never being used, but it is having an impact to your credit scores that people are unaware of. So what are some of the pitfalls with that? Opening them, but I'm going to tie it into closing them. We're going to have a separate question on the closing.
Yeah.
So,
right. So time is your friend with credit. I'll throw that out there first. And length of credit is about 15% of your credit score. So to go over that simply, let's just say I have like 3 cards. I've got card A, I've had it for 13 years. Card B, I've had for 4 years. Card C, I've had for 1 year. So that's 18 years total. I'm going to divide 18 by 3. That's going to give me an average age of 6 years for the credit that I have. So if you go out and you sign up for card after card in a short period of time, you're cutting in to the years, the length of time you have credit. And that's going to help lower your score as well. So it's not a good idea to open up a lot of cards in a short period of time. It's going to cut into all of the hard work that you build up, trying to establish your credit over a long period of time. And I will add too, since we're on the subject, store cards, they impact your credit a little bit more than, because you can only use it at that one place, that one store. So if you're trying to figure out what's the best card for me to get, a name brand card is probably a better credit card to have than,
Like, meaning Visa, MasterCard, American Express, Discover versus Macy's or Sears or
Macy's. And the interest rate's probably going to be 26 to 30%. You do you get the discount, but you don't pay it off. You're paying so much more. So I think in the long run, I don't think the discount that you get for that one purchase, they know that. That's why they do it. You'll pay more back.
right. You're in that store for a particular reason, and you may not have the ability to pay off that bill so fast. So the length, your credit history, if when I was in school, 100 years ago, they pushed, the college students to get that credit card, right? At the local department store, whatever it was. And my fraternity, we got $1 an application. So we would do it as a fundraiser. We'd go out into the courtyards, the Oak Grove, and sit there and get kids to sign up for credit cards, right? Montgomery Ward's being one of them, J.C. Penney's. And so we got $1 a piece. So you got people to fill out the cards. Now that's great. So in 1980, early 1981, 82, I'm opening up potentially my first credit card, right? Fast forward 40 years later, if I still have that card, that's one card with literally a 40-year length of ownership, let's call it, right? Now, if I open up a card tomorrow at Kohl's, I now have two cards, and I just went from a 40-year history average to a 20. And that's what you're saying is, so the more new stuff you get fast is going to dilute that length of ownership, that length of service. And so now tied to that is the second piece of to the question I wanted you to share is closing those accounts. Now all of a sudden I'm going, I've had this card since 1982 from school. I haven't used it in 35 years since I left town. And let me just shut that. Right. And so again, what I learned from your talk was this is bad.
Yes. It just like you rolled out there. If you close an older account, it's going to impact the length of credit, which we said is about 15%. So it's okay to pay down a card, pay it off, but there's no reason to close the older cards at all. The thing now that's happening with a lot of the credit companies is when they know people are doing that, and they make their money when people use the credit. So they're sending letters out saying, if you don't use the card, we're going to shut it down. So it's good if you have those cards to use it every once in a while, to keep it active, pay it off. But yes, if you're thinking about closing a card, definitely don't close the older ones. You can just pay them down, do whatever you need to do, put it in some water, freeze it in your freezer, cut it up, hide it, do whatever you need to do so you don't use it, but it's definitely helping your credit.
Yeah, no, again, this is something I've heard about over the years, but never understood the actual correlation, of how or why. So I want to, put that out as a big so what for everybody is watch what you're opening up and the volume of what you're opening up because of the shortness of that. And then if you are going to start looking or thinking about closing things down, you definitely, if you got something 6 months ago, you're better off closing that than something you got 6 years ago, right?
Absolutely.
Okay. All right, so you got 15% weighting on the length. You got the 35% on the payment history slash capacity. So I've got 50% so far. What else you got?
All right, so just to clarify, so the first two were 35 and 30, so we're up to...
Oh, I missed one. All right, so 30.
The 35 is the payment history, how you pay it. The 30% was the capacity, and then we've got the 15. So what's our quick math?
You're at 80. Now you're at 80. All right.
All right. So then we have...
I missed one. I apologize. That was my...
No
my
worries. That's why I'm the expert here today. So we've got credit mix, at 10%. What's that? So That's revolving, installment, mortgages. Actually, you explained it really well in the beginning. Like revolving cards are personal lines, home equity lines of credit, credit cards, things like that. And then you have the installment, like an auto loan or a personal loan. And then you have your mortgages, which could be for your home or an RV or or even I'll classify a boat under that since it's a big ticket item. But those are some things that you can have out there.
So the mix, the combination of how much is installment versus open or revolving is going to have some influence, because if you're in installments, right, you're kind of in a bucket of, I got a 5-year car payment, right? And at the end of 5 years, either I'm going to be getting a new car and start a new payment, or I'm going to keep the car and have no payment. But a credit card, I can just keep paying it off. You're using it, paying it, like it's a constant ebb and flow, right? Where, again, statistically, I'm sure most people accumulate them and don't necessarily do a great job eliminating them. And now they've got 4 or 5 cards maxing out, and they're stuck in that minimum payment trap, right?
Yeah, so revolving credit impacts your credit score the most. So here's a good place for a tip. So a debt consolidation loan. So if you're able to take your revolving debt and pay it off with an installment loan, that will tremendously increase your credit score, because as we mentioned earlier, when they take that capacity, you're going to go from 50% to 0% because it's all going to be in the installment loan. You're gonna
go ahead. Let me clarify again, just terminology for people to understand. So, again, you correct me if I'm wrong. We're talking about maybe using some form of a home equity access, and there's 2 types. There's installment home equity. That's a fixed payment, just like a regular mortgage, but it might be a 5 or a 10-year installment home equity line, right, or home equity loan. And then you have the HELOC, home equity line of credit. Those are revolving, right? So what you're referring to optimize somebody's credit redeployment would be, I'm going to go do a cash out refi. I'm going to take a 10-year installment and take $50,000 out of my home, add it as a second mortgage, right? Or if they don't have a mortgage, it'll be the new first mortgage. But now use that equity to get rid of the credit cards, which are revolving.
Yeah. And now some people, that is an absolute one way to go. Now, some people might not feel comfortable putting the money into their home, in case the home went into foreclosure. So there is another option. You can do an unsecured loan. So, you're not tying it to a collateral like your car or your home. So you can get an unsecured loan and pay off the revolving debt. And now you're going to have a fixed period of time. Say you do it 5 years, where you're paying monthly principal and interest, and you see a light at the end of the tunnel, and it's all going to be paid off. As long as you don't get caught in the trap of using your revolving debt again and running it up. But if you're able to manage that, you're going to find that the monthly payment's probably going to be the same. You're not going to be saving so much. You'll save money in interest because revolving debt compounds daily, right? And it just keeps adding on top of what you have. But so paying off that revolving debt is going to open up the capacity that you have, raise your score, and it's not. I guess the best way to look at it, it's not counted. You're not gonna see that debt anymore in your score because it's going to be under this other category in credit mix called installment. If that makes sense.
People, if you have questions, hit us up at info@asktheplanman.com and submit those questions in, and we'll clarify if we're confusing you instead of helping you understand that
So
piece of it. So we're at 90%. Go ahead.
Yeah, just to make it simple, an unsecured loan to pay off revolving credit card debt can tremendously help your credit score, as well as help you get out of debt with a specific period of time, a plan.
Now, to be clear, unsecured is going to be a higher rate than what a home equity might be, because it is secured. So again, people should understand that you gotta have some better or decent credit to get an unsecured loan. And if you could get it secured, the rates are probably going to be more favorable, right? And a little bit easier to get. But again, you're giving people options. That's what we're here to do, is educate them on their options and how these things work and what those components do that will influence their credit scoring up or down.
Exactly. Your lender, is your trusted advisor. They should give you all the options so you can make an informed decision. But there are pluses and minuses. You get lower rate, lower payment with the secured loan, but that might not be the best solution for somebody. Maybe they don't have enough equity to do that. So there are other options.
Okay. All right. So we're at 90%. You have something for the last 10?
Let me see. I would say it's...
Or we're going to grade it on a curve.
Yeah. I think we touched on it. So it's new debt is 10%. So inquiries, maybe, you see that a lot. People say, "Oh, yeah, too many inquiries in the last 12 months." An inquiry is called a hard pull, where you applied for some sort of credit and they ran your social security number and they got a score, and then that shows up as part of your score going forward. And what I can say about that is inquiries for certain things like credit cards are going to be more impactful and hurt your score. Why is that? Because the scoring model has to take into consideration whether you actually received that debt or not. And a credit card is probably going to take 90 days to actually show up on the credit report if you are approved. So they have to take a educated guess whether you have it. So if you have a lot of inquiries for credit cards, it's going to hurt your score more than, let's just say you go shopping for a mortgage, right? There's new laws out there. One of them is, 30 days of shopping, it counts as one inquiry. So they know if you go shopping for a mortgage, you're not going to have 3 mortgages, right? You're going to have 1. So it's incorporated in the model. Same thing with auto loans. You go to an auto dealer, they're famous for just shooting out your information to 5 different lenders, right? So that counts as 1 inquiry as well. So that's not going to impact your score as much. So
Is it the same 30 days in the auto? Like, let's say I go to 3 dealerships, and we're going to get into what happened when you helped me on ours, but they start playing games with the rates and the credit. You get this score, and I've got that score, and this one's telling me this score. But if I go to 3 dealerships and I'm interested in 3 cars and I'm getting all my information and they're hard pulling, am I getting 3 dings because in that 1 week or those couple of days, or is it same as the mortgage, like he's not buying 3 cars?
So 3 different lenders for autos, you will get the 3 dings, but keep in mind each auto dealer that's shopping for you probably sent your credit to 3 or 4 different places. So that 3 is probably 12 inquiries. Yeah.
So your numbers could plunge over the weekend when you're out car shopping and having people run your hard credit. So again, the so what here is know the term soft pull versus hard pull, right? And hope the dealer will at least do a soft pull, which is not going to register, right? That's the difference in the term. And you can at least get a sense, hey, at 2.9 versus 5.9, these are going to be your payments, right? And then they'll narrow that down for you once they do the hard pull. You've got a sense of price and the payment. And, once you figure out what car you want, then you can get to a hard number without having 12 pulls because you just didn't know what car you wanted or what payments made sense and all that type of stuff. So doing your homework. Go ahead.
Your homework, absolutely. And I guess great advice would be to try to get pre-approved somewhere from, the lender that you work with, because then you're same thing as buying a house with a pre-approval. You're a cash buyer, you're not negotiating your trade-in and everything like that. So you go to them first. You already know what your rate is. You already know what you're approved for, and you can go from there. If you want them to pull your credit, you already know you have the back end already done, and you can see what they can do to help out. But if you're just going from dealer to dealer, that's 3 inquiries, but it's really like that's going to hurt your score. But just remember that 12 different people probably looked at it already.
Right. And your credit score from the first place to the fourth place, your score could drop 50 points. And now they want to put you in a different category. Real quick, because we're kind of past our normal half-hour time, but what are the brackets? Like people say, I got an 800, I got like, what's the low? Where is the majority of people falling? And where ideally do they want to be to get that A credit? What do they call tier 1, tier 2, or whatever the terms are? What is some of that?
There's the range of scores, I would say 800, so like an 818 is outstanding. Right now, we're finding 695 is an average credit score, which is good.
Okay.
Yeah, 695. 350 is the actual lowest score, but if you have a score below 620, you're going to run into some difficulty. You'll get a loan, but it'll be the higher rates, and higher rates cost you more over the life of the loan in terms of payment. So,
all right, so there is no zero score. It's like the SATs. You get 400 points for putting your name on it. So your credit scores get 350 just for existing. Okay.
350 to about 850. One bureau goes to 900. But it's so you have over 800, that's so actually I can tell you from my inside information here, 750 with the lender is a top score. So if you're over 750, you're going to get the best rates that a lender has to offer.
Gotcha. Okay. That's great to know. All right. So let's start to bring it to close. So basically, Craig shared with us, I'm going to refer to my notes and make sure I got it all. So we've got 5 areas that influence your credit scoring. We got 35% is payment history. 30% is your capacity, how much of the money that you have access to you're actually utilizing, right? And that ratio. What else do I got here? I got time, the length or the average length of your open lines of credit or influence. The longer cards and open lines are better for you than the newer stuff. The new stuff impacts and knocks your average length of ownership, if you will, of credit. That's a 15% influence. That gets us to 80. Your credit mix, the difference between installment versus revolving, and then the new debt, the inquiries of constantly getting stuff. So I think the math says that's 100% for those driving in their car. And so that is awesome. And we hope that this episode of Ask the Planman help you, the public audience, get some understanding, maybe some better control or some tips here on how to manage your credit, how to avoid damaging your credit inadvertently, which I guess a lot of people have been doing based on what I've done for the last 35 years, not knowing some of this. I have, closed cards and gotten rid of things. I don't need that anymore. It's really, and as you said earlier, we talked about the rewards point type style cards. I went years, I just ran them up, paid them off, ran them up, paid them off. Like I didn't know about the closing date. So that for those who are doing that is a valuable tip to help improve. If you can't get over 800 and you're sitting at 750 and you want to get to 806, well, these are some ways that maybe you can bump it up. And if you've been struggling, obviously there's again, we're not going to have time to get into it, but there's debt consolidation companies and other places. We could do another show maybe on something like that. So thank you so much, Craig, for being with us. I think it was super informative, and I'm glad that you're able to come on. And this has been Ask the Planman, everything you want to know about finance, insurance, and more. I'm your host, Bruce Weinstein. Please like, subscribe, share, comment, hit your favorite podcast, our YouTube, whatever it is. You can call us at 1-844-PLANMAN. You can go to our website, asktheplanman.com. You can email us at info@asktheplanman. But hit that subscribe button. We'll see you next time. Thank you again, Craig, for being with us today. And everybody stay well, and we'll see you next time at Ask the Planman.